what we had been talking about prior to this were the two different ways of analyzing things. And what were those two different ways? This whole chapter talks about three ways. Horizontal and vertical analysis. Horizontal analysis compared year to year, right? And vertical compared upward, whether you did the income statement or the balance sheet. And actually, prior to coming in here, I'd been talking with the dean at Forest Park about accounting enrollment and the fact that how it had been over the last probably 3 years, and that, you know, just we're trying to get the accounting lab be more of a district lab. He sent me a spreadsheet because I went out and I had a look at what you were looking at, Alto, like each semester, like how many people are in it, and I had to count it up. Well, there's reports you could get to, but not all of us are lucky enough to have access to those reports. So he ran a report and sent it to me, and it had each campus since 2008 in their enrollment. And then it had all accounting classes together for all campuses and kind of showed it and went like this. Well, the college has gone like this. I told you it has decreased. So I went through and I put ratios. You know, I turned it into percentages because you can't compare Merrimack to Forest Park, Wildwood, and Flo Valley when Merrimack has 56 to 60% of all accounting classes. Because what do you think Merrimack looked like when there was a graph showing decline? If you got a graph with numbers on it, and the highest number is something like 6,500, and the lowest number being 0. And you got 3 of the schools ranging somewhere around here. Their graph's going to go like this, right? And you got 3 of them kind of doing the same thing. And then you got Merrimack's that goes like this. Which one looks worse? The top one. However, when you hit 6,500 and then you get down to, these are like at 1,800, so that my numbers don't really go very well. This number here, I think we're closer to like 4,800. And we actually went up this year, like that. That one just looks worse. But these all still had the same thing. So what I did is I started like here in 2015, and I went and I did a horizontal analysis from year to year for the last 5 years. I didn't do it, I did 4 years actually, school year 15-16 to school year 16-17 and such. And when I did that, actually what it showed was we were all kind of similar. Merrimack in 2 years ago had a big drop. The other schools, Forest Park, had 2 big drops, an increase, and a small drop. And Flo Valley just had constant kind of teen drops. And I kind of left Wildwood out because they just kind of had the same numbers. I mean, they dropped 20, added 20, dropped 20. But when you're only sitting at 500, you can go up and down 20, and it's a 10% increase. So when I did that, that drop didn't look as severe. And then I sent it back to the dean, and he goes, well, Forest Park looks like they basically have stayed constant, and Merrimack had a huge drop. And I had to respond back, and I'm like, no, they didn't. Forest Park dropped 10% or 19% and 20% in the first 2 years. Then they went up 8, and now they're down 3. I said, Merrimack did this. I said, everybody's dropped, just different amounts. I said, you can't look at the fact that Merrimack had a huge drop by 2,000 students. We had almost 7,000 students at one time. So that's what these analysis does. You can go in and compare things where if you do a graph, you got to be so careful when you look at graphs. And even when you go out and you look at the stock market, and you see these graphs, and you go out and you look at the first one, and you look at something like Google, and you go out at Google, and you see a graph going like this. And you're like, wow, they're up and down today, right? But then if you look at their graph is going from 1,000 to 1,010 to 1,020. Are they really up and down? They're going up $10, right? Or you can go to another one that's doing that. But now you look, and they're doing this. Well, Google is jumping more. Every graph you pull up when you go on the stock market has a different X and Y axis. Well, usually the X-axis is the same because it's the year. Okay, it's the time of day and the year. But this one is different. It depends on the dollar that the stock is trading at. If you got a stock trading at $10, this is only going to be in ones. If you have Google stock trading at $1,200, I don't even remember what it was at now, $1,300, this is going to be in the thousands. So that's where you need to use the horizontal analysis. You got to compare year to year of two different companies. Okay, now granted we are one college, but when you're trying to compare 4 different campuses, you can't compare Wildwood to Forest Park. Forest Park has 1,800 students. Wildwood has, in accounting, Wildwood has 500. At the same time, when you sit here and say Wildwood's grown 22% and the other campuses are down, well, that's kind of hard too, because that means Wildwood has gained 20 students. Is gaining 20 students the same as, the other campuses being down 2%? So you kind of got to take everything in perspective when you look at these things. So the vertical analysis isn't quite the same. Vertical analysis is usually only done internally, and it is kind of a little bit harder, but you can compare and say your gross profit is 25% and Lowe's gross profit is 30%. If Lowe's goes into it knowing they can make 30% and Home Depot can only make 25%, they have a much better chance of making more money, right? They're starting off 5% better than Home Depot. That means they're getting their cost of goods sold at a better price. That means Home Depot is not doing something right. They both should be able to get their cost of goods sold at a similar price. Now, Ace Hardware, should they have will they have a higher cost of goods sold? Possibly. What is one of the disadvantages of a small business?
Can't buy in bulk.
You can't buy in the same bulk. You don't get the volume discount necessarily, right? Now, they have other things. They don't have as high as expenses in some other areas, possibly. Okay? But that's why they specialize in things. One of the things, that you see some advertising for Cotton Ace Hardware, they specialize in service. That's one of the things they talk about. You go in there and someone's always going to help you. That is not always the case in a Home Depot or a Lowe's. They're usually around when you don't need them, and you can't find them when you need them. All right, so that was our horizontal and vertical analysis, right? And that is something that you should all be able to use no matter what, even cybersecurity, all right, when you're looking at other companies. You're going to be looking at risk analysis when you're looking at companies, or inside a company, what you're going to look at. When we did IT security, we did risk analysis, trying to figure out what we're going to be looking at, how we're going to look at. And a lot of times we looked at ratios or analysis going backwards and forward. And when we did risk analysis of trying to figure out who we were going to audit on the IT side, we used horizontal analysis from year to year on their security side and what had been happening. So you use a lot of analysis. Now, financial ratios, not so much on cybersecurity, but this is one of the slides that I left my other class with. Now, you do not need to know on the next couple slides what each ratio is. Okay, they're going to be categorized here in a minute. You do not need to know what ratios are profitable, which ones are solvent, and which ones are liquidity. But you should know what each of these terms mean. All right, profitability should be the easiest term to know. If something is profitable, it means we are making money. So a profitability ratio means the company is making money. That should be the easiest one. Profitability means making money. It's the other two terms that people don't necessarily know the true meaning of. All of you guys are going into some type of business, right? Some are thinking accounting. Some don't know what they want to do in the business world. But you need to know what liquidity means, and you need to know what solvency means, right? Solvency means, can you pay your interest and debt? It does not mean that you have cash on hand. It means you can pay your interest and you can pay your debt when they are due. So basically, in a lot of ways, it kind of means you are bill to bill. But you can pay it, therefore your creditors are happy. You are solvent. You can pay your interest and you can pay your debt. this is a personal thing too. You are solvent in your personal life if every month you can pay your bills. Now that doesn't mean you're getting anywhere, because if all you're doing is paying your interest on your credit cards and your interest on your home and your interest on your car, you are never going to get out of debt, right? But you're solvent. You're paying your debts, right? Liquidity means that you have enough current assets to repay your current liabilities, all right? Can you pay your current liabilities with your current assets? If you are not liquid, you are typically not going to survive. All right, so liquidity is current assets over current liabilities. Can you pay your liabilities when they are due? So that is difference between the two. So liquidity ratios and solvency. Now, you should know all of these ratios. As I said, we're not going to sit here and go through each one. You've done them all. Those are the 6 ratios that fall under profitability. One of the things that you should notice is that each ratio, with the exception of one, has what in it? If you're trying to figure out if you're profitable, what do you have to have in it? Sales or revenue. All right, sales is kind of revenue, or sales or revenue, net income, which is sales or revenue, right? It just has expenses taken out of it. So sales, revenue, net income, those are all coming from the income statement because you're trying to see if you are profitable. The only one that doesn't is your PE ratio, but it's taking your stock price over your earnings per share, and earnings per share has net income in it. Okay. Liquidity ratios, what did we say liquidity was?
The ability to pay current liabilities.
Right, ability to pay current liabilities. So you are looking at receivable turnover and inventory turnover. How quick are you collecting your receivables? If you're not collecting your receivables, you can't pay your debt because you're not collecting your receivables. Inventory, how quickly are you selling your inventory? If you're not selling your inventory quickly, then you're not making money. Therefore, you can't pay your debt. And then your current ratio, which is obviously current assets over current liability. So see how those kind of fall into liquidity? And then your last 2 ratios, debt to asset and times interest earned. Both are solvent. Can you pay your debts? And times interest earned is can you pay your interest? All right, so the results of all of our financial analysis. So horizontal analysis, what does it ultimately mean? So our cash for Lowe's grew by 37.8% in 2016. So their cash went up. The biggest percentage change is in other current assets. This doesn't tell us where that is. What is other current assets? How would you be able to figure that out if you were an investor? Where would you look? Because cash went up, but other than that, other current assets, and if you come down, the next biggest thing is other assets. How would you figure out what those were? Where would you look? Think about the annual report. We had one slide that went over this. You have all your financial statements in there, but the financial statements don't necessarily tell you information, right? I mean, it gives you data. The notes to the financial statements are going to describe what's on the financial statements. So if you want to know what's in current assets, you got to go to the notes to financial statements. If you want to be that big time investor someday, if you want to be Warren Buffett, you got to be able to understand the financial statements. Understanding the financial statements is not just reading the numbers. You are going to have to go into the notes and figure out what all these numbers are. Because it's easy to know what cash is. But when you come out here and see that their other current assets went up by $126 million, what did they do? What did they buy? And then their other assets went up by $118 million. What did they buy? What is Lowe's buying? Actually, now I'm curious. What do you think they bought? Well, that would be inventory. because they're going to turn around and sell that. Other assets are going to be something that they own, but it's not going to be an inventory because inventory is going to be turned around and sold. Could be, especially if we come down here, because that's long term. They could have bought stocks and other things. Other companies looking at investments. Well, buildings should be under property, plant, and equipment.
Would it be like, would it be advertising?
No, because that would be an expense. Yeah. See how when you sit here, you start wondering, what is that? Because if it's software or if it's patents, that should be under long-term intangibles. So the way you find out is you go look in their annual report. And they're going to describe that under the notes to the financial statement. I don't know. I didn't go look. This is a brand new book. I haven't looked. If it would have been in the last edition, but when you're looking at a problem, I'll see if I can look it up real quick. All right, vertical analysis, I said, was going upward, usually only done internally, whereas horizontally you can do all sorts of different things. So that might be a hint when you're studying for the test. I don't know. I'm just saying that horizontally is used a lot more often, in my opinion. Vertically, we're looking at going up and down. So what is vertically telling us? I already been using this number a lot. 65% is cost of sales, 25%. This is our profitability. That is the most money we can possibly make. That is such a big number. Gross profit is such a big number. And then the net income we've already talked about is 48%. Well, 4.8%. When we already know that gross profit is 35, that number right there is going to control what our net income is. You only have so much control over your cost of goods sold. Right? You can go out and find different vendors and try to do it, but when you're a company like Lowe's and Home Depot, think about all the different vendors they have. I mean, you're going to tweak that cost of goods sold, but are you going to have a major impact on that 65%? No. It might be 65.5 or 64. It might go up and down a little bit. Your biggest impact is going to be that operating and other expenses. And then they can look from year to year. But when you increase sales, you typically increase cost of goods sold. They kind of go hand in hand. If you increase one, the other one has to go up. And there, though, if you notice, they actually decreased operating expenses. How do you decrease operating expenses? What is the largest operating expense in most companies? Come on. People. Most companies, the biggest expense is us. So that's why when you hear of a company cutting back, GM, what's the first thing you hear them saying they're going to do? Yeah, they're closing a plant, so therefore they are laying people off. Right? They don't say we're going to relocate these people to other plants. They're laying them off. Right? Would they like to be able to say they're relocating all the employees to other plants? Absolutely, because then they'd look fantastic. But that's not going to save them money. I mean, it would. They're closing a plant, so they'd save money. That's not going to save them the money they're looking at. And then how do we do our ratios? Well, we know how to do our ratios. So the next numerous slides go through a whole bunch of ratio calculations. And we know what they are. We got our net profit margin, our gross profit margin. All right, how well they're doing. I'm hoping that you know these from doing the annual report. This is one of the areas that in Chapter 13 is where you could have found explanations if you had a hard time to your ratios, was in Chapter 13. They were also on your slides. Did anybody look at these slides for the...
I looked at the book on that page.
You found that page, okay. I didn't mention they were in the slides, but as I go through all these, you will notice they're all here, except for the one. What was the one ratio that you had to look up? Or was it actually in this book this time? Was there a ratio you had to Google?
I Googled one. I don't remember what it was, though.
I believe it was asset turnover. Isn't that right? I didn't give it to you, but I told you you had to Google it. All right. Here's our receivables. Stop bouncing. All right. And then our debt. So debt to asset ratio, they tell you Home Depot's is 0.9 or 90%, which you guys already told me. Lowe's is 9.1. So, or no, Lowe's is, sorry, 8.81. So obviously Home Depot's in worse shape. Why do you think one of the reasons could be Home Depot's in worse shape? Who's bigger? Home Depot. So therefore, would it be reasonable to think that Home Depot has a lot more buildings? Okay, and therefore a lot more debt. That doesn't mean it's okay. That just could be one of the reasons their liabilities and their assets, they probably have a lot more loans, I would think, out on those buildings, assuming they own the buildings. All right, and then I believe this is the last one. So accounting decisions, what do we do? When you're looking at the financial statements, one of the things you got to look at in the notes to the financial statements is you have to look at different things like their strategies. How are they financing? What was the difference between equity and debt financing? You guys remember that? We did a problem on it in class. Debt financing means how are we getting our money? We're borrowing it. If we borrow money, we incur what every month? Interest. But the positive thing about interest is we can deduct it on our taxes, which means it lowers our lowers our taxes. Okay. But equity financing, give me a positive or negative, either one.
No interest.
No interest. Do we have to pay it back? No. What's a negative? You lose a portion of your company every time you do it. Make sure you know the difference between those two, okay? So when you're looking at a company, you need to go in and see how are they financing. Are they doing a debt? Are they doing equity? Are they doing both? Right? If you're looking at a publicly traded company, you know they're doing equity, but you got to find out how much. Right? That's why one of the questions I asked you on your stock was what percentage of their sales, like our stock, I wanted you to go in there. I don't think it was this class, but one of the stocks that somebody looked at in my other class had no inside stock owned. I think it might have been Honda. I think it was Honda. That surprised me. No insiders owned Honda stock. Huh? I don't know the answer. I've never had anyone pick Honda before. Did any of you guys have a stock that had nobody own? What was just Chrysler didn't either. I wonder if that's a car thing. I might have to look. Huh? Did anybody else have a car?
Yeah, I did.
You had Tesla.
25%.
Okay, but Tesla's weird. That's a different car. I'm going to have to look up the other car places now that Honda, I'll have to look.
Could not find it because it just said NA.
No, it said NA. And actually what Honda said was 0. It said 0%. So I don't know if that means people have owned it, but that's interesting. All right, then you got to look and see what's the difference in accounting methods. Do they use FIFO, LIFO, weighted average? Do they use straight line, double declining, units of production? Because remember, FIFO, LIFO, weighted average, does that affect your net income? Yes. So if you're comparing companies, you got to look at that. And then how are they difference in operations? Quantity of the items sold. How are they taking care of things? Here's our depreciation. Right? Now, does anybody remember Builder's first choice? Okay, Builder's Square. Doesn't surprise me you guys don't. I remember when I first moved here. Now, I grew up in Michigan and then I moved to Ohio. And the town we lived in, Ohio, was really small. But my dad worked for Chrysler and then went on to General Dynamics, which he made parts for the tanks. And so when we moved to Ohio, he worked for the tank plant. And so we had nothing. Like, we lived in Lima, Ohio. And so when I moved here, he came here and we had a Builder's Square. And it was like Home Depot. And he used to just go. He'd get up in the morning and go get coffee and just walk around Builder's Square. Because we had there was nothing like it. That was the first of like the Home Depots and Lowe's. They were not everywhere yet. And so that was that. That is what this was. Obviously they still exist because this is a new book and they wouldn't put them out here. They still exist of some sort. Notice the difference between how they take depreciation. They mostly do straight line. But if they do it 5 to 40 and 5 to 45, but they do their buildings starting at 20, that's going to be a big difference in depreciation expense because 20 years is going to be a lot smaller than if they do some buildings at 5. That's going to be a big depreciation difference. And here, they do 2 to 15, 2 to 20, they do 3 to 10. So their equipment's going to be depreciated a lot faster than their buildings. And that creates expense, which affects your net income. So those are things you need to know also. And then you have to think of things when it comes to how they externally report their things. And that's the final end product of everything that we've done this semester, is reporting externally. Okay? The whole objective of financial reporting is to provide useful information to the external user. Everything you've done this semester, the whole purpose, and I told you guys the very first day of class, what this class was for you to learn how information is provided to the external user for decision making. That you would see the process of how the external information is provided so that the external person could make decisions. The class you're going to take next, or most of you will take next, is how you prepare all the information for the internal user to make decisions. How is a salesperson going to make the decision? How is a marketing person going to make the decision? Which might be you guys, all right? The external user can also be you guys, because you guys might be looking at other people's stock to make decisions on whether or not to buy it. All right? It has to be relevant, it has to be faithful, it has to be comparable, it has to be reliable, it has to be timely. All those things that we're looking for, because we have to do things quickly. All right? And then it talks about the different things that we measured and reported, and then the different units of measure, separate entity, time period, etc. The main thing on there is why did we do everything we did. And then going concern. Going concern means, can the company continue to operate the way it's been operating? So let's pick on Sears. All right? We're not picking on Toys R Us, because Toys R Us kind of just, unless you're following Toys R Us, which I wasn't, Toys R Us kind of came out and said, we're done. Right? They didn't come out and say, we're struggling, and over a 5-year period they disappeared. They kind of came out and said, we're done. And it's sad. That one actually made me more sad than Sears. But Sears, over the past probably maybe 5 to 10 years, it's been at least 5 years, has been struggling to stay alive. And probably 3 to 5 years ago, they bought out, merged with Kmart. Kmart was struggling, so they bought out, merged with Kmart. And a lot of Kmarts closed, but they kept a few open, and they became part of Sears. And they closed down a lot of Sears, they did a reorganization of Sears, and they kind of changed, I don't want to say they changed their target, they always kind of had that same target, but they became a lot more, I thought, focused on back to their outside hardware, appliances kind of focused, bedroom, machine, washing machine, that type of thing. All right, and over time they kept struggling, and then they closed more down probably 2 to 3 years ago, and then this past year they announced that they couldn't do it, that they were closing. Now Sears and Roebuck has been around. I remember my grandparents built a house in Arkansas when I was probably 5 or 6. So my grandpa got transferred down there, and he worked for Monroe Auto Parts, which built parts for cars, and they were down in Arkansas. And he built his house. He helped the people build his house. And in the basement, they had a bathroom that he picked the wallpaper, and it was Sears and Roebuck wallpaper. I'm not kidding. So it was all advertisement, and he actually had a big old-fashioned catalog of everything that you could buy from a Sears and Roebuck store. And it was probably from like the 30s, the catalog. I mean, it wasn't it was just a replica of one. But the whole bathroom had that, and I used to think that was so cool that that was what the store was. And I mean, that's how they've been around for so long, and now they're gone. Well, they're not. I think they're gone. They're gone. So basically what happened? Everything on the left side. Declining sales, gross profit, big one-time expenditures, income, net income was going up and down. They were revealed other analysis. They lost key suppliers and customers. Well, customers, they were losing us, right? What happened to them? Home Depot and Lowe's? Do you think that hurt them? Yeah, it did. Other things that hurt them? Online, definitely, because other things that you could get that were not those type of bigger items, you could get online. They could not expand. They had a lot of unfavorable long-term commitments that they could not stay up with. So that is what happened. So that's called the going concern principle. So basically that's chapter 13. So as we talked about, you know most of it.